All right. Um, Good morning and good afternoon, everyone. It's my absolute pleasure to welcome you all to the third session of guest lecture series at CCIT. CCIT is Center for Comparative and International Taxation, which is a think tank under the aegis of Chinil Global Law School. Today we have with us Dr. Raffaele Petruzzi, who is the Managing Director of the WU Transfer Pricing Center at the Institute for Austrian and International Tax Law at WU Vienna University of Economics and Business, and an international tax advisor specializing in international tax and transfer pricing. We are also joined by Mr. Abhishek Padwalkar, who is a research and teaching associate at the WU Transfer Pricing Center at the Institute for Austrian and International Tax Law at WU Vienna University of Economics and Business. I would request the speakers to please I welcome them to start with their presentation.
I'll quickly share my slide. Yeah, I hope everyone can see it right now, right?
Yes, we can.
Yeah, okay, good.
So, good afternoon, everyone. Good morning, and thanks a lot for the kind invitation. Thanks for the introduction. Saurabh, Kriti, Sana, thanks for organizing this great event. Please do not confuse Austria with Australia. They even make T-shirts in Austria, no kangaroos in Austria, so that is quite apparently a big issue. Although I'm not Austrian, I'm originally from Italy. For the ones of you that do not know me, yes, but I live and work in Austria for a while, where I'm heading up the Transfer Pricing Center at the Institute for Austrian International Tax Law. So we are an academic institution, a public university, and we are probably one of the largest center specializing on these topics. So feel free to interact. Feel free to interrupt us. We have scheduled a 2.5 hours presentation that apparently will last only 1 hour. We have plenty of topics to discuss, but we don't want to be slaves of the slides. So feel free to interrupt us with your questions and your considerations, so that we can have a lively discussion. So, topic, Abhishek, do you want to briefly introduce yourself as well before we start?
Yeah, so I think Sana has already introduced me, and thank you, Sana, Kriti, and Saurabh for the kind invitation. And my name is Abhishek, and I've been working with Raffaele at the WU Transfer Pricing Center since the last 1.5 years, basically focusing on transfer pricing issues. And before joining the WU team of transfer pricing, I was basically doing my LLM from Amsterdam, and before that I was also working in India as a tax lawyer in the Bombay High Court and in the Bombay ITAT. And it's really a pleasure to be joining you all for this particular session, and hope we have a very lively discussion. So yeah, that is it from my side, and I think we can just jump into the slides.
So yes, thanks a lot. Topic of the day: transfer pricing in relation to businesses in economic and financial distress. Something pretty interesting, I would say, for the ones of you that are passionate or somehow interested in transfer pricing, because the way that we used to deal with transfer pricing is, and the way that the guidance is conceived when dealing with transfer pricing is typically guidance or topics or understandings for periods where transfer pricing the economy works well, when we have stable economic periods. If you read the OECD guidance, indeed, There's not much mentioning of losses. Most of the guidance is pretty positive. And the same is with the UN manual. There's all the time discussions on what happens when you have profits, what happens when you are, as a multinational, in a profitable situation. But we found out that quite often we have situations of crisis, and there's the need to change somehow the understanding of transfer pricing topics in this period. So the agenda of the day will basically introduce the topic really quickly, then go into the transfer pricing 4 steps analysis. We'll look at some other issues and then have further thoughts together. So, next slide, please. As you can see from this slide, one of the points we wanted to make is that crises, unfortunately, are something that happens very regularly, although we tend to always remember what was the last crisis, or somehow what were crises that we have been experiencing during our lives. We don't keep memory of other crises, but you can see it from this slide that crises are indeed pretty regular, and therefore in those unstable economic period like the ones that we are living now, we need to reconsider everything, including how transfer pricing works. So if we jump into the next slide, unless anyone wants to make some comments. A point that we wanted to make before starting and dipping into the transfer pricing analysis is that during a crisis, it's also pretty important to highlight that some win and some lose. It's not always the case that you have during a crisis everybody losing. So you can see here some of the negative impacts, for example, of the last crisis caused by the COVID-19 pandemic. We had, of course, an economic crisis and decrease in purchasing power. We see it also in the after the pandemic. Now that the pandemic has become somehow endemic, and there's not big issues with the virus anymore, at least up to this day. Still, a crisis always brings a decrease in purchasing power, and that has an impact also on what we will discuss later. Lockdowns, and of course, we had several effects on revenues caused by the lockdowns. We have skyrocketing levels of debt, private debt, public debt, and unprecedented uncertainty regarding the future. This is what we are experiencing nowadays. On the other hand, we also have some positive impacts. For example, COVID-19 has accelerated digital transformation processes of many companies and also many governments. During a period of crisis, there's also development of new business ideas. When things get difficult, then you start thinking how you can improve and do things differently. Restructurings of supply chains, and eventually we experience more and more of these, and companies are indeed discussing how to face the challenges deriving from disruption of supply chains. Probably a country like India, I was reading in The Economist, will benefit from these restructurings. I was reading about Apple probably doing more and more activities there. And so this is typical, a typical positive impact during crisis. And cost savings, of course, we've seen also with remote working that companies have reached some cost savings. They don't have to own necessarily big buildings in order to produce, and so that is something also pretty positive. Next slide. I think this is for you, Abhishek.
Yeah. So So like in this slide, we say that just because there is an event of economic downturn, it does not really mean that in every situation you do have to change your transfer pricing analysis. So over here, we have three scenarios. So in scenario one, we have intergroup transactions which are covered by agreements pre-existing the economic downturn, where the facts and circumstances have not changed. So over here, we had the particular transaction which has not really been impacted by the change of the facts and circumstances of the particular case. Whereas in scenario two, you have intergroup transactions which are covered by agreements pre-existing the economic downturn, where facts and circumstances indeed have changed. And also in scenario three, we have intergroup transactions not covered by the agreements pre-existing the economic downturn. So over here, we have certain kind of transactions which were not at all covered by the agreements, but they do have to be undertaken because of the event of economic downturn. So as you can see in scenario one, you won't really have any change of your transfer pricing analysis. Whereas in scenario two and scenario three, you have the facts and circumstances which have changed because of the event of economic crisis. And that is the reason you would need to have a new economic, or you would need to have a new transfer pricing analysis in place. So as you can see, the transfer pricing analysis is really grounded in the facts and circumstances of each case. And you do have to do a case by case analysis to see whether there is a change in the transfer pricing policy or not.
So as you can see from this, I think the main message is when a downturn happens, we don't have to change necessarily everything. So this is a point that also the OECD guidance on COVID-19 and transfer pricing has made. And this is an important point because quite often you see people saying, oh, there is a downturn, we need to change everything now. No, this is not true. You have to change when when facts and circumstances indeed have changed, which will happen quite often, but not all the time. Another point we want to make, because we are going into this analysis, this is basically explain to you briefly what do we mean for four steps analysis. When we solve every transfer pricing case, we have developed, looking at the guidance from the OECD and from the UN, we have developed in Vienna a step-by-step analysis that help us somehow finding out where do we start from and where do we end up in every transfer pricing analysis. So we call it the four steps analysis. The first step is the accurate delineation of the transaction. So the OECD tells us, get the contracts, read the contracts, but then make sure that contracts are aligned with the reality, with the conducts of the parties. So this is the first step where we have to find out what the real deal is. The second step is the recognition of the transaction. So we have to make sure that indeed the transaction would have happened between two unrelated parties. Otherwise, the transaction should not be recognized. Then the third step, once you make sure the transaction is fine, you go into selecting the most appropriate transfer pricing method and applying it. The fact that step 3 comes before step 4 is because it is somehow better to use the right method with wrong comparables than the wrong method with right comparables. And this is why it is important first to select the most appropriate method and then to apply this method. And now we will go into all these steps, looking at what has happened during the economic downturns and what happens during typically economic downturns. So delineation of transaction. For the ones of you that are transfer pricing experts, you all know what this means. You have to look at contracts and make sure they are aligned with conducts, meaning facts of the case, looking at the other 4 economically relevant characteristics, meaning functional analysis, functional assets and risks, characteristics of property and services, economic circumstances, and business strategies. And out of this process, you will find out what indeed the real deal of a transaction is. So let's see how this changes or what are the changes that might happen during an economic downturn.
So as Rafael already mentioned, the contractual terms, they do form the starting point of any transfer pricing analysis. And over here also, in the event of economic downturn, you really have to see what the parties have actually entered into. So what is the particular contract, or like what is the particular transactions which we are dealing with? And as you all know, that a particular contract or an agreement usually have the rights and obligations of each parties which are listed. You also have something as an event of default and consequences of an event of default. And usually when one party is not able to fulfill its obligation under the contract, the other party can either take the party to court. It is like it can sue the party, or it can really renegotiate the agreement as well. So basically you do have to see what are the options which are realistically available with the parties. It could happen that to fulfill the long-standing business agreements between the parties, instead of going into litigation, they would really prefer to go to a renegotiation of the contract. And you really have to see in each facts and circumstances of the case what are the options which are realistically available with the parties. And also you have to see whether the law really allows for renegotiation of the contract or no, because usually if you have a contract which is already frustrated, then maybe the law does not allow the renegotiation of the contract after it has really expired. And also, one of the important things to see, especially in the events of economic or financial downturns, is something called as a force majeure clause. And as you all know, force majeure clause forms part of almost all the agreements which we enter into. And this clause is usually dormant in most of the situations, but it gains importance in times of economic and financial downturns. And usually uh, the force majeure clause covers events which are out of the control of the party. So you have events such as acts of God, say wars, or changes in governmental policy, so on and so forth. And it like really depends on how these contracts are worded or drafted. And when a party invokes a force majeure clause, it has to fulfill three conditions. So first, it has to show that the impediment is beyond the party's control. Secondly, it has to show that the impediment could reasonably not be foreseen when the contract was entered between the parties. And thirdly, that the effects of the impediment could not have been avoided or overcome by the parties. And when you have fulfilled all the three conditions, only then you can invoke a force majeure clause. And then while we were going through like some of the force majeure clauses, we came to a conclusion that you have something as an endogenous crisis and an exogenous crisis. So an endogenous crisis is basically something which derives out of risk of doing a business. So basically, if a party is in a financial crisis because of bankruptcy, then you cannot take refuge of force majeure clause. But an exogenous crisis is basically something which is affected from outside circumstances. So something as an act of God or war would be an exogenous crisis. And we have realized that for a force majeure clause to be invoked, usually in cases of exogenous crisis, it is usually successful to be invoked then in the case of endogenous crisis. And while we were going through some of the cases in US after 2008, 2009 financial crisis, we came to a conclusion that like when you had force majeure clauses which did not have words like economic downturn or financial crisis, in those situations, even though there was a recession, the courts basically refused to invoke these force majeure clauses. Whereas in cases where you have words such as changes to economic circumstances, which are beyond reasonable control of the parties, in those cases, the parties were successful to defend the force majeure clauses. And at the end of the day, it usually depends whether the parties would take this option or not. So just because the force majeure clause can be invoked does not really mean that the parties would invoke the force majeure clause, because it could happen that when you invoke the force majeure clause, there's usually a suspension or a termination of the contract which the parties would not want. And to sustain the long-standing business relationship, maybe they want to uh, just renegotiate the contract with new terms and conditions. So at the end of the day, it actually depends on how these force majeure clause is worded. So whether a particular event of financial crisis does fall within these force majeure clauses. And secondly, you also have to see what are the options which are realistically available to the parties. So a third party would only take a particular option or opt for a particular option if it is the economically best option in a particular situation.
So just the main point we want to make here regarding contracts is that you have indeed to behave during a downturn as you would behave in normal circumstances, meaning that you have to think of what you would have done with third parties. And just to make an example, you are in your office, you're working, suddenly a client calls you or a customer calls you and says, or sends you an email and says, okay, we are in an economic crisis. We cannot pay for this year. We have to postpone to next year, or we have to ask you for a discount. Please, can you do that considering the situation right now? Then in the future, maybe we will pay you more to take into account this particular emergency situation. What do you do? Well, again, there are different scenarios. The first one, you think, okay, I want to maintain a good relationship with this client or customer. I will allow for a discount, I will allow for a postponement of the payment, so forth, because somehow we all have to make sacrifices during this crisis in order to maintain good relationship. The other scenario is to say, no, sorry, the contract says that you have to pay me today, you have to pay me this amount, I will not allow for any discount or any postponement. I'm also somehow impacted by the crisis, so if you don't pay me, I also cannot survive, so please pay me, otherwise we go to court. And so these are a couple of scenarios you might have to encounter when it comes to contractual terms. So you have to understand, of course, how you would behave. Keeping in mind that in an intergroup situation, probably the scenario will be the one of maintaining good relationships, because if you're not interested in maintaining good relationships, then why would you be in the same group? Of course, we have to consider various factors, but this is somehow the main message we wanted to give when talking about contracts. I don't know if you guys have any reaction or any consideration right now, or if you, yeah.
Yeah, I agree. I think especially on the force majeure clauses, even the OECD agreement says that OECD transfer pricing guidelines say that even if the agreement contains a force majeure clause, it cannot automatically be assumed that the COVID-19 pandemic is actually sufficient to invoke these clauses for that matter. Yeah. So
indeed. I think we can, in the interest of time, jump in the next slide. So, of course, apart from contracts, we have to look at the trinity in transfer pricing: functions, assets, and risks. So this is the functional analysis. And of course, in times of an economic downturn, we have to check whether some functions have changed, and it might be the case that indeed in an economic downturn, functions change in order to make the situation less bad, as we might have encountered if we don't change anything. So companies do change functions when it is a time of an economic downturn. And so question is, do the function change in order to reduce losses or to remain profitable? Should these functions change? If I was a third party, would have changed something? Well, probably yes. It depends on, of course, on the specific situation, but in some cases we may see even limited risk entities to perform more functions. Think of a limited risk entity, a limited risk distributor that cannot sell much anymore, because of the lowering purchasing power in the customer base. What do? Well, you might start even undertaking more marketing efforts in order to sell your products or services, even if you are a limited risk entity, because of course, otherwise you yourself will not survive as a limited risk entity anymore. So being a limited risk entity does not mean being a no risk entity or a no function entity. You still have to do some functions, and in times of an economic downturn, you might even increase the amount of functions and work that you perform. Same is with assets. Also here, you might employ extra assets. You might employ some extra activities, and or you might change the use of your assets. So for example, you are an entity that does warehousing. All of a sudden there is a lot of capabilities in the warehouse because maybe the business doesn't go as in the past. You have a lot of empty space because products do not arrive, microchips are not produced anymore. That's what happened during COVID. So all of a sudden you might have extra space in warehouse. What do? Well, if you want to exploit that factor in order to make some extra profits that are always useful in times of downturns, you might rent out some of the space. Same is true if that happens, that you have a lot of products, but they are unsold because customers, as we see, again, just to make the example of the IT products, are not buying anymore those products because they bought enough during the economic downturns, during the COVID lockdowns, when people didn't know what to do. They were closed in their apartments, and they bought a lot of laptops. Now, of course, no one wants to buy laptops. What do? You have a warehouse that is full of products, so you cannot sell them. So you might have to ask someone else to keep your products to somehow handle all these extra products there. Risks are also very important in general in a transfer pricing analysis. In an economic downturn, that's when you actually see risk materializing. So we always talk about, okay, we have to look at the financial capacity to assume the risks and the management over risks. But often this is an exercise that in a stable economic period, we do it more from a theoretical perspective. The answer is always, yes, I have money, I have people, I can manage and control this risk. But during an economic downturn, that's when things might go wrong, and risks do materialize. And of course, you might have to somehow take into account who indeed is the real risk taker based on the materialization of those risks. Another important point that we wanted to make here is that temporary changes in functions, temporary changes in assets, temporary assumption or different assumptions of risks might not always lead to a complete change in your transfer pricing analysis. If you do something different for a couple of weeks or months because of that specific period, you don't have necessary to say, now there is a huge business restructuring going on, we have to change everything. So that is something important to distinguish between temporary and permanent changes in an economic downturn.
Also, when you have these like limited risk entities which end up assuming certain risks in times of economic downturn, you basically have to see whether they do have the financial capacity to bear the risk, or it is ultimately the parent entity, it is somehow compensating these limited risk entities. So you do have to, at the end of the day, do your functional analysis to find out who is actually the risk taker, even in these like times of crisis.
Any point or question on this?
I think, Kriti? I'd like to invite our wonderful director at the CCIT, Kriti.
Thank you so much.
Questions.
Thanks, Anna. I think no questions as yet. I totally agree with you, the importance on risks as well. But just wondering, do we again go back to chapter 1 of the OECD transfer pricing guidelines when it comes to risks as well?
Of course, I think that chapter is important for stable economic period as much as periods of economic downturn. So yes, we have to somehow derive from there how to behave in times of economic downturns. And that guidance clearly tells us, look at where's the financial capacity and the control over the risk. So that's what you have to do also in times of downturn.
Sure. We also have a question.
You have a question? Yeah.
Yes, we have a question on the chat which says, can entities operating under limited risk arrangement be said to incur losses in a COVID economic crisis world, given that guidelines doesn't define limited risk?
We will go into that topic soon, so please hold with us, because what we are trying to explain now is how the delineation changes, and later we'll go into the attribution of profits or losses based on these changes in the delineation. So we'll reveal the answer to your questions soon. Maybe we can go into the next slide.
Yeah. So over here, we also have to see whether there is any change in the characteristics of goods or services which are offered by the particular entity. So usually for say like a tangible goods or services, the important characteristics would be like say the nature of the goods or the availability of volume, the reliability, so on and so forth. And as you have already seen that even in the situation of COVID-19, you would have seen that many of the apparel manufacturers, they started manufacturing masks or clinical suits. And also say like you had fragrance companies which started manufacturing like sanitizers or disinfectants. So in these situations, you had the changes in the characteristics of goods and services which were offered by those particular parties. And also with respect to an intangible, so what are the factors which are important is the degree of protection, the level of protection, and the duration and the future anticipated profits or losses that particular intangible would derive in future. So basically like you have seen that like in times of the COVID crisis, many of the pharmaceuticals and vaccine manufacturers, they had to let go their patent protection, because for the greater good of the society, the government said that you cannot really have the patent protection in these situations. So you also have to see whether there was any changes in the nature of products and services which were offered. You have seen that many of the entities and companies, they did really well in times of COVID, but other entities, they had to change the nature of the products and services which were offered just to survive the nature of the crisis. Also, with respect to economic circumstances, the OECD lists some of the economic circumstances which are relevant for the accurate delineation of the particular transaction. So over here, we have the geographical location, the size of the markets, the purchasing power of like the customers, the governmental regulations, like so on and so forth. And in an event of economic crisis, you would have one or all of these like economic circumstances which could be impacted, and that would indeed affect also the transfer pricing analysis. You would also have situations of government assistance. So as you have seen after the 2008-2009 like crisis, and also in the COVID crisis, there were many of the governments in the world which offered support to these entities which were going through the crisis. But over here, we have to see what is the nature of assistance which is provided by the government. So it can basically take many forms. It can be by the way of a loan. It can be by way of job retention programs. It can also be by way of, say, like a capital injunction to these entities, and how each of these government assistance would impact the facts and circumstances of the of the case would need to be analyzed. You also have to see whether the particular entity who is getting the government assistance, should the assistance be stable at the level of the entity, or should it also be distributed to other entities? So these are like some of the economic circumstances which you have to take into account. Also, with respect to the business strategies, there could be changes in the assumption of market risk. So as already mentioned by Rafael, you would have limited risk entities which would also end up taking certain risks just to float in the time of economic crisis. And you have to, in this situation, see whether this type of business strategy, it has been taken at the level of the entity, so at the level of the routine entity, or at the level of the parent entity. So if the routine entity is taking this kind of business decisions, and if it has the financial capacity to bear the risk, then if there are any losses, then the losses have to be attributed for like to that limited risk entity. But if these business strategies or these business decisions, it has been taken at the level of the parent entity, then the parent entity should get the profit or the loss which is generated because of these business decisions.
All right, moving forward in the interest of time, the next step of the analysis is the recognition of the transaction. Of course, once we make sure that contracts are aligned with conducts, we have to make sure that the contracts and the transaction are actually something that two third parties would have entered into. This is the guidance provided by the OECD. The OECD tells us that indeed a transaction might be disregarded where there is no commercial rationality in the transaction that prevents the determination of mutually acceptable prices, taking into account the options realistically available. So let's look at what this means in time of economic downturns.
Sorry, yeah, just going ahead. And so as you like as already mentioned, the transaction has to be economically rational. So what do you mean by economically rational? So in times of, say, like in a normal situation, for any business, making profits would be economically rational, but that might not be the case in times of crisis. So in times of crisis, you have to make sure that the business survives. And for the business to survive, many a times it could happen that you have to do business under a loss or under a situation of no profit and loss. So there could really be a change in an economically rationality of like the particular transaction or the particular business, because it could happen that, so for example, in terms of like COVID crisis, when the matters would be scrutinized, say after 4 or 6 years, and the tax authorities would see that, okay, there is a loss in a particular situation where indeed it has to be a profit, but they have to also say like take into account what was the market condition at that particular time, and that it could happen that it did make economic sense at that particular time to conduct the business in a loss. And like over here, if the transaction does not make economic sense or it is not economically rational, then the tax authorities can either not recognize the transaction at all or recharacterize the transaction. But if you do take the step of not recognize the transaction, then you would have a situation where it could lead to double taxation. Also, there is also like a risk of business restructuring, whether the changes in functions, assets, and the risk, which are temporary in nature, whether it should lead to a business restructuring under transfer pricing or no. And then at the end of the day, you also have to see what are the options which are realistically available to the party. So if the parties have agreed to conduct the business under a loss-making situation, was that the best option in this particular facts and circumstances of the case or no?
So just to make an example on this, well, imagine you are giving money, you're giving a loan to your to a third party, and all of a sudden, in a period of a downturn, that third party cannot eventually pay the interest related to that loan, or cannot repay partially the capital on that loan, and so forth. What do you do? Well, in a normal situation, what would be economically rational would be to say, please keep the loan, and let's go ahead as we were planning. But in an economic downturn, you might be willing to provide again for somehow postponement of the interest payment, or you might be even renouncing to some parts of the loan in order to get some other parts, so what you can still get from that loan. So this is something that would normally be irrational, and so tax administration pretty easily would say, okay, if you're giving up some part of the loan, that probably means that that loan in an intragroup situation should have been not a loan, should have been equity. But in an economic downturn, probably the meaning of what is rational changes, and therefore we need to change also the assessment of intragroup situations consequently.
Yeah. So if like a party considers that a particular say like entity is really important to it for its own business purposes, then it could like very well take these decisions as well.
Let's look at the third step, the selection of the method. Here you have the 5 methods. I think all of you are familiar with them: traditional methods, transactional methods, profit methods. So you see cap, resale price, cost plus, TNMM, profit split. The main concept, of course, is that you have to apply the most appropriate method. There is no hierarchy between these methods. And now we can see how these methods change, or the selection of these methods changes during downturn.
So like over here, we have the CUP, or the comparable uncontrolled price method, which is the first method. And in practice, this method is really difficult to apply because it is difficult to find that level of comparability between the transactions, or between the goods and services which are offered. So in a regular situation, you won't find many of the instances where CUP is applied. But if you have a situation where there is an internal CUP, so an internal CUP is basically where you say like carry out a particular transaction with third parties and also with your group entities, then you have a potential internal CUP. And in that situation, this would be the best method which can be applied. Also, in the times of economic and financial distress, you could have entities which are like usually like captive entities, which only cater to say like intragroup situation. But just to survive the crisis, they also start offering goods and services to third parties. And in that situation, you already have a CUP, and you can also apply a CUP in like those situations. And so basically an applicability of the CUP usually depends on real-time information, which might or might not be available. So it really depends on if you have say like that level of data to apply this transfer pricing method. Secondly, you have the resale price method. In practice, again, this is a very difficult method to apply because there might not be the right level of comparability. There might not be the right level of comparables. And also, this method is usually applied to say like limited risk distributors, and you might not have enough information about the gross margin even in like regular situations. So again, this might not be the best method in the time of like crisis. Also, the cost plus method. In time of crisis, you would have extraordinary costs which could be incurred because of the event of economic or financial distress. And it would also be, say, like a bit difficult to consider what would be the cost base where you have to apply the markup. Then the fourth method is a transactional net margin method. In practice, this is the most used method. So you have 80 to 90% of the transactions where you would be using this kind of a method. And this method is usually used for routine entities. But when you're doing your analysis, like in times of crisis, you have to really see whether that routine entity is a routine entity which is not taking any market risk at all. If it is not taking any market risk, then you can still apply the TNMM. But if it does end up taking some risk, then you have to really assess whether TNMM has to be applied or no. And if you do come to a conclusion that you still at the end of the day have to apply TNMM to a particular kind of transaction, then maybe you can also change your set of comparables. So you can say like add loss making comparables to your data set, or you can use a lower quartile instead of a median, which you would be using in regular situations. And finally, you have the transaction profit split method. So this is a two-sided method. And this method basically takes into account that both the parties to the transaction, they are say undertaking like heavy risk and are also undertaking some important functions. And you would have that in an economic or financial downturn, both the parties to the transaction end up taking substantial risks. And you would have that this method would be applicable in those kind of situations. So you basically have to see whether you apply one-sided method, and when you apply a one-sided method, it basically would over aggravate the losses to other entities which might not be at arm's length, or you apply a both-sided method, which is a cup or a transaction profit split method, which takes into account the facts and circumstances and the risks which are assumed by both the parties. So it could be a situation there if you already have a cup in a particular case, then it would be the most appropriate transfer pricing method or the transaction profit split method. But then again, you have to do your function analysis to come to the conclusion which of these methods would be most appropriate in the transfer pricing scenario. Then going ahead, how do you apply this method? So this is the fourth step of the analysis. So if you have come to a conclusion that a particular method is the most appropriate transfer pricing method, in the time of crisis, you have to see whether that like the method which you have used in the past still holds. So if you do come to a conclusion that the method selected has not changed, you have to see whether its application has changed. So if you do come to a conclusion that the TNMM is still the most appropriate transfer pricing method, you have to see whether its application needs to be changed. So as already mentioned, you can have a situation that instead of applying a median, you're like now applying a lower quartile, or you're using a different set of comparables for the TNMM to be applied in a better situation. Or you would like maybe come to a conclusion that the method which you have selected is not the most appropriate method. So in the regular situation, you are using a TNMM, but now you have a potential internal cup, and you come to a conclusion that a cup is the most appropriate transfer pricing method. And some of the factors to be taken into account. Obviously, in time of crisis, it is very difficult to find comparables, because when you're using like a transfer pricing method and you're using say like a set of comparable for these transfer pricing method, you're using basically say information with respect to the past. And the economic crisis which you're like facing right now would not have those set of comparables. So what you can do is you can maybe use like comparables from the past economic crisis. So if you're doing a transfer pricing analysis in times of COVID, then maybe you can use comparables which you can be used say like in the 2008 or 2009 financial crisis. But again, that crisis was different. So you have to see which of the entities were really affected by those like financial crisis, and whether they are comparable in the true sense or no. Also, the comparables which you see in the data set are the comparables which have survived the financial crisis, because you would have say like a situation in which the third parties have really not been able to sustain the financial crisis. But when you see the data set, it would still have certain comparables which have survived. So basically, there is like an extent of a survival bias in favor of the related party. And also one of the situation is that you can use multiple year averages in which the comparables have suffered financial distress. So you can use a particular comparable which has suffered the financial distress, and you can use multiple year averages. And also many a times you would have listed companies which comes out with the quarterly data which can be used as a comparables again. And obviously not all the time you would get 100% result, because each company and each transaction is different, and it would be required to be made adjustments. But you also have to see whether the law allows you to make those kind of adjustments or not.
I think just to conclude on these concepts here. So, well, first of all, when selecting method, usually we tend to go for profits based methods, especially the one-sided TNMM, because that is what we think should be used in cases of limited risk entities. But we have seen during the past crisis how difficult it was to derive profits information in real time, because of course usually financial statements of small companies are published with a delay of 1 or even more years. So maybe in times of economic downturns, a CAP might give you more real-time information when available. And secondly, the points that we are trying to make here might also help us answering the question that was asked before, whether a limited risk entity, I guess a limited risk distributor was in the question, can incur losses. Well, of course, the answer in a transfer pricing environment is always it depends. It depends on what situation we are having in mind, and maybe the situation that I have in mind right now is completely different from the ones that the person that is asking the question has in mind. But yeah, in my view, also a limited risk entity during times of economic and financial downturn can have losses. As I mentioned before, being a limited risk distributor or limited risk entity in general doesn't mean that you don't have any risk at all. And when the entire group is in a loss-making situation, when the economy is not doing great, and when your company is in financial and economic distress, then it might happen that you also suffer from this. And of course, you might not have a significant amount of losses. Most of the losses will stay with the risk, with the ones that are taking most of the risks, meaning the principal entities of the group, but also the ones that have limited risk might incur losses, or at least not have the profits that they used to have in the past. So that is something that also the OECD guidance has clarified during the COVID period.
Yeah, but then you would have situations where say the jurisdiction where these limited entities are located, they might not really be happy with losses being incurred to these limited entities, because as you know, after the 2008 financial crisis, China came up with a circular that the limited risk entities in our jurisdiction would not be entitled to suffer losses. So they won't really be happy with this kind of.
No one is happy to have losses, either in times of financial distress or in times of a good economic period. No one is happy to get losses. The fact that you are not happy with getting losses does not mean that it's right not to get losses. You have to look at whether an independent party would have taken losses, whether companies have suffered losses, even when they were limited risk entities, whether they would have suffered losses or not, and that gives the answer to your question. Otherwise, if we start justifying not getting losses just by saying I'm not happy with that, then no one will allow deductibility for losses. So yeah, I know that some tax administrations might not be happy to have losses. But this is something somehow that might play also in an interesting way with your country, with India, because often tax administrations in the past have been saying, we have full-fledged entities here, we have all the DMP functions here, we have companies that are not limited risk because they do much more than just being a contract manufacturer or contract R&D centers. And now all of a sudden you have a period of economic downturn. If you were arguing for that, then that means that you take a significant amount of losses as well for the same reason. So what is really important is to delineate the transaction and look really at what two independent parties would have done since the beginning. If you're really a full-fledged entity or not, then of course you take a lot of losses in times of economic downturn. If you're really a limited risk entity, then you should not get that much profits, but also not that much losses, but still as much as you can get some limited amount of profits in times of economic stability, then you might get a limited amount of losses in times of downturn. Otherwise, if you see an entity with zero chances to get losses, that is not a limited risk entity, that is a zero risk entity, which is a different scenario. I think that we are running out of time. I don't know whether we want to stop here or whether we want to go into this last couple of slides. I'm really open to your suggestions.
I think we can go through these slides in a quick fashion.
Okay, I think most of it we have already covered, so we can just quickly go through it.
Exactly. So I think a lot of these topics we covered them. Some considerations for some specific type of transactions. So when it comes to services, of course, also in cases of low value adding services, you might, in times of downturn, incur extraordinary costs, and then you have to understand who should take these costs, whether it should be the service provider or whether it should be the principal entity of the group. When it comes to financing, of course, a lot of consideration change with reference to credit ratings, to interest rates, to intergroup guarantees, to whether you should pay for a loan, whether that is an equity injection. That is something also that you need to consider in time of downturns. Intangibles, of course, DMP drive the remuneration for intangibles. Well, in times of downturns, as we've seen with COVID, when people all of a sudden start working from different locations, they start working no more from the office, they go and live in other countries. How does that impact your DMP analysis? In my view, the entity that is responsible for those people, the one that is employing those people, the ones that indeed take the consequences of the actions of those people, the ones that make them available all the facilities, the ones that incurs the risks related to something going wrong with the activities of those people, should be the DMP entity. So it doesn't matter, in my view, where people are working from. For me, it really matters who are these people working for? And that's something that might not be that straightforward all the time. Restructurings, of course, when we go into changes due to the economic downturns, we might see more and more discussions over whether there is a restructuring or not. As we mentioned before, not all the time that things are changing, especially if those are temporary changes. We should see restructuring from a transfer pricing perspective. Although the chances, of course, of having a restructuring in a downturn because of the changes in supply chains, because of the disruption happening, because of the fact that you develop new ideas to do your business, again, restructurings might be something to monitor in times of downturns. Other issues we put out there, probably this slide is self-explanatory.
I think most of it we have already discussed. So I'll just quickly go through it. So like, as you know, like limited risk distributors versus entrepreneurial entities. So you really have to delineate the transaction to see whether the limited risk distributor also in the scenario of an economic downturn does end up bearing certain risk or no. Even if there is a certain risk, then you have to see whether the entrepreneurial entity is providing any kind of assistance or any kind of shortfall to the profits of the routine entity. With respect to internal versus external comparables, of course, the use of internal comparables is like a better in kind of economic downturns, but you have to also take into account that they do satisfy the comparability factors which are mentioned by the OECD. And it could happen that the real-time data might not always be available. So again, you have to make certain adjustments. Loss-making comparables are usually excluded from any data set, and the tax authorities are also not really happy when you include loss-making comparables in your data set. But then in an economic downturn, it could be important that you also include, say, like the loss-making comparables if these companies are truly comparable. But however, if you include these loss-making comparables, which are usually having persistent losses, then it could like really vitiate the comparable set. Also already mentioned government assistance. You have to take into account what is the kind of assistance which is provided by the government, and you have to see which of the entities should receive this assistance. So if you have a jurisdiction which is providing this assistance, and if you distribute this assistance to other entities in your M&E, then the government might not really be happy with the decision. So you have to see whether this particular kind of a government grant should remain with the entity which receives it, or it has to trickle also down the value chain. Yeah.
So some final thoughts on this, but of course, these are quite general points. I'm more interested in knowing what the questions are from the audience. Just maybe one point there concluding is that, of course, the OECD has provided some guidance specific to COVID-19. We know it already. The UN is also working on transfer pricing guidance related to COVID-19 issues. So I'm personally involved in this project, and hopefully will issue something soon. And Abhishek and I have been working on this topic on a paper that will be hopefully soon published in the context of the work of the European Tax Law Professors Association. So hopefully you will read our paper soon. But yes, I think now it's time for the questions, and happy to get questions from the audience.
Thank you, for the immensely insightful presentation. I think everyone from the audience would agree with me that this has been very useful for all of us at CCIT and Jindal in overall. We're really looking forward to reading through your paper on this particular topic. I think as I see it from the last slide as well, I think the thrust will be on transfer pricing documentation. Obviously, there is considerable importance that we give to economic analysis and comparability factors. But I feel that there will be increased focus that should be laid down on industry analysis as well. So as to exhibit how the entire business sector in which the M&E is really operating, how are they facing the challenges out of COVID-19 or any other economic downturn, and how are they coping up with those challenges that ways. I wanted to jump in to present more points as well when we were talking about business restructuring as well. In terms of, I think businesses will have to undertake an effective value chain analysis as to see if this will be within the purview of business restructuring, and if an entity would require an indemnification in terms of probably reduction in the functions, assets, and risks because of the economic downturn. As far as my question is concerned, I was just curious to know your thoughts as to if there's a business which is affected by an economic downturn, and this business is also currently under it has APA which is currently being negotiated. How should that business go about it? So if there is always that option of withdrawing from the APA, but I'm just afraid that there is a fee which is associated to the APA, and that might not be, generally refunded. And the second, the biggest fear is that there is some information which is, provided to tax authorities that could be used for future tax audits. So primarily, how should a business go about, that particular situation? Sorry, Rafael, you're on mute.
I think you're
sorry,
yeah.
I muted myself to listen to your interesting questions. Yeah, that's an interesting question indeed. In general, when you are in an APA situation, you are in a cooperative environment with the tax administration. So you have been having discussions already to conclude the APA, or they are leading to the conclusion of an APA. So pretty much the situation is something that should have been clarified in if that's an APA that was an old one before the economic downturn, or whether it's an APA that is still in discussion. But nevertheless, since APA's answers and commitments by tax administration are very much grounded on the facts, the specific facts that have been assessed during the APA and discussed during the APA, I would say that if things indeed have changed because of the economic downturn, then I would really try to contact the APA team, which have been negotiating my APA with, and see whether they see any changes to happen there. Because the risk is that if you don't really discuss this, then in the future, the same tax administration that is agreed on the APA might say, look, I don't agree with what we have concluded because the facts have radically changed during the downturn. And so, yeah, I think it's always important to stay in touch with the tax administration, and if things have actually changed, then probably the conclusion of the APA should change as well.
Because the APAs usually have something called as a critical assumption clause.
Correct.
So it basically assumes that the facts and circumstances of this particular transaction would remain the same. And if an event of economic downturn does drastically change like this, then like obviously the APA can be maybe negotiated or I don't know, like terminated.
Thank you so much.
Welcome.
We have some questions in the chat as well.
Okay. Should we read the questions, or you prefer to ask them yourself?
Kriti, would you like to go ahead, or?
We have a question in the chat tab, which is, again, what happens to businesses in the middle of APA negotiation that you just answered. We also have a question that doesn't deal with economic downturn, but on the general importance of TP regulations. It says, considering the aim and objective of TP regulations to attribute income where value is generated on arm's length basis, why did digital enterprises like Amazon, Google, and Facebook lobbied against tweaking TP regulations, virtual PE, to allocate income on arm's length basis in market jurisdictions where the value is added to digital enterprises?
It's like a whole different discussion.
It is a different discussion altogether.
Not sure that I can answer to that in a short time. The OECD has been working on this issue probably since 2005 when it started talking about e-commerce. Yeah, it's very complicated. I think we need an entire new seminar. Sarab, maybe you want to think of the next seminar already, and this is for sure a topic that could be discussed and explored in the next seminar.
Sure. Another thing, do you think that we would witness a shift in, the kind and nature of transfer pricing disputes with tax authorities going forward because of these economic downturns?
I think transfer pricing discussions with tax administrations will become more and more relevant. It could be because of the economic downturn, so everybody has different expectations on what might change in an economic downturn, and of course that will imply discussions and disalignments in the understanding of taxpayers and tax administrations on these changes. For me, what is also another driving factor of the increased discussions between taxpayers and tax administrations is also the discussions that are happening on digital, as it was referred before. I think there is somehow different concepts that have been raised during those discussions, and those concepts probably are not so far well addressed or well clarified, or a solution has not been found yet, and those will lead to more discussions between taxpayers and tax administrations, also in the context of transfer pricing audits. So yeah, we'll see a lot of more discussions happening because of the downturn, because of the economic situation, because of digital discussions, and yeah, good to be a TP expert in this period.
Absolutely. Yes. Do we have any more questions, Sana?
I don't think so. Economic downturn, I think we've done that.
Sorry, I think I missed out. We have another question if you don't mind taking at this point.
Yeah. Yes, Kriti, go ahead, you take it.
There's a question on the chat tab which says, how effective are the econometrics-based predictive modeling analysis? This is recommended by the OECD. Is it sufficient in constructing a robust arm's length range?
Well, I think they could be helpful. To be honest, the question when we want to really find out the profitability of a transaction should be very much based on actual observations and third-party behaviors, based on contracts, based on the clauses of a contract, and so forth. So something more sounding like a statistical approach is something that could be used eventually to make adjustments to the observations, but basing the entire remuneration of a transaction only on statistical approaches might be dangerous, because statistics often are based on assumptions, and so changing those assumptions leads to completely different results, and therefore that results reached by a statistical measurement might be challenged then in discussions with tax administration. So useful support, a useful way also to come up with a corroborative analysis or to make adjustments, but as a primary method to define profitability, or as the only method to define profitability of a transaction, might be quite challenged.
I second that. Yeah. Thank you. Sana, do we have more questions?
I'm just checking in the chat box. I'm just checking if hopefully we haven't missed anything. So stop. I think we're pretty much done with the questions. So
we have a lot of requests for a TP and digital enterprises separate discussion to be organized though.
Absolutely.
Okay.
Okay.
yes. All right. So I think since we've finished all the questions, I would like to thank Dr. Raffaele Petruzzi and Mr. Abhishek Padwalkar for taking out time for doing this very intriguing session on transfer pricing. And I'd also like to thank Professor Kriti Chawla, who's the director at CCIT, and the entire team at CCIT and everyone who's joined in and taken out time to attend this session. Thank you all so much.
Thank you very much.
Thank you. It was a pleasure.
Raffaele, thank you
Looking forward to
so
staying in
much
touch.
for taking time out and delivering this lecture. Abhishek, to you too, thank you so much. Was really an insightful session. So, and I hope that we can conduct another session on transfer pricing or have regular sessions on transfer pricing and can collaborate with, with the center on, with your center on some projects. But yes, thank you so much, Raffaele. It was an honor and pleasure to host you.
It was a pleasure to be host. Thanks a lot for giving us these opportunities, and we will be very happy indeed to continue our fruitful cooperation.
Thank you so much.
Thank you so much.
Okay.
Thank you. See you soon.
Yeah.
Thank you.
Bye.
Bye-bye. Yeah. Bye-bye.
Bye.
Ashish, you can stop the live now. Thank you.